Hi, welcome back to You Heard It from a CFP. My name is Matthew Coyle with you as always from Minneapolis here with Advanced Capital Group. It is episode 51 of You Heard It from a CFP. Today we're going to talk about the markets, we're going to talk about inflation, and we're going to talk about the question, was that it? Did we just see peak inflation? Was that it? I'm not trying to make market calls, but we may just have seen it. I've got some charts to show you what I'm talking about. Let's dive in. So much like the markets, inflation is a tricky thing to call. Sometimes it heats up, sometimes it cools down, kind of tough to call in the short term, but I've got some data here that shows you inflation in the short term may have just peaked, which may be good for the economy and good for the markets and good for your retirement plan as well. So let's take a look at some data I've got here. I've got a bunch of charts. I hope you like charts because you are about to get a bunch of charts, but very interesting ones at that. So let's take a look at what I've got here. We're going to start with the first half of the year. I'll start by kind of tearing us down here for a moment. I'm going to talk about the first half of the year and why it was so bad and why it was so tough to be an investor. You're probably aware of a few of these things, but interesting to put it into charts and just see historically what a unique first half of the year 2022 was. So we'll start with that. We'll start with the first half of 2022, why it was so tough, why it was so hard to be an investor, probably worse than 08 in many ways. And then we'll talk about inflation and what we're currently seeing. And then we're going to talk about the markets in the future. And we don't do individual security recommendations here, as you well probably know, but we can talk about different areas of the market, what look attractive, what maybe look a touch still maybe too expensive. But we're going to look at that right now. Let's start off with some data on the first half of the year. Okay, let's start off looking at the first half of the year. I don't want to spend too much time on this, but just because I like to look forward rather than back. But let's look at what made the first half of the year so tough for investors. And if you believe in reversion to the mean, could get a whole lot better. So let's look at the S&P 500. We'll start there, which of course is a widely followed proxy for U.S. large cap growth stocks. Probably the most famous, besides the Dow Jones, probably the most famous index in the world as far as the equity markets go. So S&P 500, first half of the year, let's start there. We're going to look at the S&P 500. 21% down first half of the year, not seen since the early 1970s. Very, very difficult, of course. 1970s, not a fun time to be in the market anyway during the 1970s. Not many fond memories for most people who've been in the market that long from the 70s. However, that is what the market did in the first half of the year, the S&P 500. So not fun. Moving on to the NASDAQ. The NASDAQ, of course, first half of the year, worst since 1985. So really you could say worst ever. I think the NASDAQ started back in 1971, 72. But for the modern era, the modern NASDAQ, you would call it, all the way back to 1985, worst first half performance of the year in 2022 compared to any other year since 1985. So in the modern era, worst first half of the year for the NASDAQ. Now left by itself, that would be not entirely surprising. It does happen sometimes where you have really bad years in the market. That just happens. However, in years like 2008 or 1974 or other years, you could count on your fixed income instruments to do a little bit more for you, your bonds to do a little bit more for you. If you owned, let's say, a 60-40 portfolio or a 70-30 portfolio, you could count on your more conservative investments being a little bit better, right? In the first half of the year, not the case. Let's look at the 10-year bond. Now, this particular chart, this is from Deutsche Bank. It goes all the way back to 1787. I don't know what proxy they're using for 10-year bonds back in 1787, but maybe IOUs from the Continental Congress. I have no idea. But worst first half for the 10-year bond ever recorded, ever. It's so bad that Leo has left the room, apparently. He can't even take a look at this. So worst first half of the year for the bond market ever recorded since whatever they're using. So thank you, Deutsche Bank, for taking all that data from 1787. I don't know. So let's cap that off. So you couldn't really count on your bonds for doing anything. You couldn't count on your equity investments to do anything. So realistically, that left you nowhere to hide. There wasn't much to go around as far as returns in the first half of the year. But have we seen peak inflation, which is driving all this selling, and rates are driving all the selling to begin with? So let's look at that next, and we'll take a look and see if we've hit peak inflation. All right, so the first half of the year was awful. There's no other way to put it. There was nowhere to hide unless you had barrels of oil stored in your basement or you were in all cash, which most people just don't invest like that. Matter of fact, that portfolio by itself the last 10 years would have done quite poorly. Energy has not done all that well the last 10 years, but in the first half, it did amazingly well. So unless you were in anything but that, you did quite poorly. In fact, you may have lost a significant sum of money depending on where in the market you were. If you were in some of these high-flying tech stocks, you would have done even worse than most of our clients have done. Very, very poor results in some of those areas. However, with some government bond funds down 15 to 20%, average, total bond funds down 9 to 12 maybe, equities down what they were down. Tough start to the year. So let's look forward and let's look at what was actually driving a lot of this selling, which was increases in rates, increases in prices, commodity prices shooting through the roof, supply chain issues still hanging over the market. Let's look at right now commodities prices. Okay, we're going to take a look at commodities prices, and we're going to look at, have we potentially seen peak inflation in the U.S. maybe early summer? Some of these prices now are starting to come down, and I'll start with this chart here I have in front of me, second quarter futures prices on commodities. Whether you're looking at oil, nat gas, soybeans, wheat, corn, copper, cotton, lumber, many of these prices in the futures markets have now come down significantly. So it started right around the first or second week of June. There is no one day it started, but commodity prices are definitely coming back down, and it begs the question, have we in the short run seen peak inflation? Of course we could go higher. Anything can happen, but have we seen peak inflation in this country? It's an interesting question, but we're starting to see selling on the equity markets ease up a little bit. It's not down every single day like it was. We're getting some up days, some down days. It's starting to flatten out a little bit. And did we see peak inflation because now some of these commodity prices are coming down? Very interesting to look at. The next one we'll look at is a specific ticker, which is an ETF that trades under the DBC. The DBC is an ETF that trades, quite widely in the public. It's a public ETF that you can buy, publicly traded ETF. And what we'll do is we'll look at this chart here, the DBC 6% daily decline. It's very rare you get 6% daily declines in a publicly traded ETF. That's very rare. And we've seen a few of them now where the markets just basically trade straight down for the day and they don't come back at all. This is actually good news for inflation. This means that commodity prices are coming down. So again, the argument could be made, and this peaked around the same time, was right around the first, second week of June. Have we seen peak inflation? It's an argument you could have. It's certainly an interesting argument to make. And we're starting to see this in the commodity markets now. So that's the commodity markets. Let's look at the market for workers' pay, which is kind of interesting as well. All right, next up, we're going to look at worker pay. One of the biggest drivers of inflation in the last, let's say, year and a half, has been the increased amount of worker pay going into the system, in addition to stimulus payments and COVID issues and supply chain problems and things like that. Worker pay has contributed to this increased demand that we see for things in like automobiles and other places. So let's look at the workers' recovery. This comes from the Bureau of Economic Analysis. This is a very interesting chart that shows you the difference, the various sources between where workers' payments are coming from, where income is coming from. This shows you taxes, stimulus check payments, employee pay, interest and dividend income, things like that. Where's this money coming from? Where are workers getting their money from? And if you look at here back in March of 2020, I'll highlight it right there. That was, of course, COVID-19, wave one. And that was when we were pumping money into the economy. Whether you agree with it or not, I don't do politics in this particular video series, but whether you agree with it or not, there's a lot of money going into this particular, into this area of the economy. And a lot of money being, of course, funneled into demand for products that we couldn't always produce or couldn't get from other places or even our own country. So you fast forward to March of 2021, and there it is again. I'll highlight that. A lot of money going into the economy. This money has now started to work its way through, and again, could contribute to the argument we have that maybe we've seen peak inflation. Worker pay has slowed down a little bit. Stimulus payments and stimulus checks, they're not sending those out anymore. So it's a very interesting argument to make that we could see not just peak demand for commodities, which I've just shown you, those prices are coming down, but worker pay and the source of that compensation, whether it comes from employee pay or stimulus payments, those have started to level out, and that money has kind of worked its way through. If we were to get another stimulus program, of course, maybe another wave of some other COVID outbreak or whatever, if that were to happen again, we may see a similar stimulus payment again. I don't know, but that has definitely worked its way through, and we're seeing less and less than that. So very interesting, that particular part of what's driving this inflation and what's driving demand is just simply worker pay that is is now starting to slow down as far as the rate of increase of free money being handed out, free money being passed around. So certainly that is a good sign for inflation as prices come down. All right, so that is a look at prices, inflation, worker pay, things like that are contributing to the very things that are causing a lot of the problems we have in the markets right now, or did the first half anyway. Let's change gears here and look forward. If you are looking to put money to work, and we're not going to recommend individual securities, although we will look at 3 of them. We're not recommending individual securities. Do your own homework, talk to your advisor if you use one, or if you use us, great, talk to us. However, we're going to look at 3 individual areas of the market where if you are going to put money to work, what looks expensive or what looks relatively cheap, given the earnings that we see or that we expect in the economy right now, okay? I'm going to show you 3, a large cap, a small cap, and a mid cap ETF that are widely followed ETFs. They happen to be iShares products, okay? They're the small cap, mid cap, and large cap ETF that represent the S&P 500 for large cap, the S&P 400 for mid caps, and the S&P 600 for small caps, all right? Let's start off by looking at returns on a portfolio of $100 invested in each 3 of these since roughly 2010. So I'll put that chart on the screen right now. And there you can see in the orange line, this particular graph showing you that an investment in the iShares S&P 500 Growth ETF would have yielded you what it yielded you, roughly about 13.6. And you see, of course, the small and the mid-cap stocks, small and mid-cap indexes doing what they've done, roughly about 11.5 on average percent between the two. Now, obviously, if you have new money to put to work, most people don't invest in the sense that they put a ton of money to work right away and then they never do it again, right? They invest in increments. They contribute to their 401k plan, or maybe they come into some money through an inheritance, or maybe they sell something, or maybe they get a bonus at work and they want to put some money to work. Whatever it is, most people invest incrementally. They don't invest all at once. Almost nobody does that. So if you have money to put to work, if you're looking for new places to put to work and you're a little scared of the market, what has sold off relative to earnings that makes it a little more attractive, let's say, to enter at a particular time? Not recommending a particular security, although we're going to look at 3 of them. Let's look at the current price to earnings ratio of the S&P 500 as it stands right now, and this is according to FactSet. Right now, if you look at where the price to earnings ratio is, the PE ratio, and again, the price to earnings ratio, as a reminder, I've done this in previous videos, but the price to earnings ratio is simply a measure of how expensive something is relative to what the earnings of that security are. So you're buying earnings of a company, earnings of an index, earnings of whatever, right? That's what a stock or an index represents, earnings of what you're buying. What is that company making? What is that index making? Right now, according to FactSet, you have about a 17 to 18, depending on what you look at, how you're looking at the numbers, about a 17.5 to 18 forward-looking price to earnings ratio versus the earnings on the S&P 500 expectations. If you look at the PE of the S&P 400 mid-cap, medium-sized companies, okay, we looked at large companies, now medium-sized companies, mid-sized companies, this has come down substantially. So if you believe the earnings that we're expecting to see, or if you don't believe a recession is coming that's severe, mid-cap and small cap, and I'll put that on the screen next, mid-cap and small cap stocks are looking a little bit more attractive. Okay, so right now, if you believe what you see, I'll go back to the first chart. If you believe that a very significant recession is coming, or we're going to see very, very significant reductions in company earnings, for example, right now the market probably has further to go. Okay, probably, we don't know. If you are looking to put money to work, the parts of the market that have seen the most damage relative to the earnings expectations that we reasonably foresee forward, and this is an aggregation of analyst expectations, keep in mind, then the small and mid caps are probably where you would start looking. And again, we're not going to recommend individual securities here. We don't do that. But if you believe the earnings, and I'll go back to the S&P 500 again, this is large caps. If you believe that these, and this should be on the screen, if you believe that the earnings on S&P 500 companies are not going to go significantly negative, they probably have a little bit more to fall. If you believe that earnings on mid-cap or small cap, and I'll start with the mid-caps here, have flattened out, which they seem to have the last few quarters, 3 or 4 quarters. If you believe that's not going to significantly go down, if your earnings estimates are close from some of these analysts, then realistically, small and mid-cap is probably where you want to look, and I've put the small cap up here as well. The S&P 600 is the small cap index. Then probably the small and mid-cap areas are where you want to start looking. Okay, that's just an initial take on it. if you have any questions on that, please feel free to reach out to me. I don't want to get into individual securities, but it's very interesting to see how the large caps, the small caps, and the mid caps have all responded to this on their forward PEs, and that's where you see most of the damage in the market are large caps, small cap stocks, and mid cap stocks that have traded far below their historical average PEs. The S&P 500 really has not crossed a threshold yet that you would say it's significantly below its historical PE ratio, especially if we are seeing any type of shallow recession or reduction in earnings. So interesting to note there that the small and the mid caps have seen the most damage. If you're going to start there, that's probably a good place to start. Do your own homework, do your own research, and if you have questions on that, please feel free to reach out to me. All right, well, that is my take on it. Now, I would add a couple more thoughts to this as I conclude this video. Number one, if you're going to make equity investments, let's say strategically or try to time things, I don't always recommend that, but if you're looking to put money to work and you are looking for ideas, always keep in mind that if you're going to be in the market, do not put anything in the market that you need, let's say, in less than 3 years. That money should not be in the market. It needs to be in a much safer place like time deposits or a bank savings account or something that you can get to it with no market risk whatsoever. So full disclosure there, I prefer to make market investments if I have 5 years or more on this particular investment. So just a word to the wise in that I would not make any investments unless I had probably 3 to 5 years minimum on the time frame before I needed that money. So just keep that in mind. The other thing I would add to this is that it's a very tough time in the market to be invested, but in the long run, recessions, and if we do have a recession, it tends to be a really good time to invest. I think I've used a chart before, but I'll throw it up on the screen here, that investing during recessions over the long run really, really has paid off in the past, and there's no reason to believe that wouldn't be true in the future. People are always looking for a return on their money, and they're going to buy things when it's cheap, because that's when you make your money, is buying things smartly, not by selling them at a higher price. You always make your money on the buy, not on the sell. Always remember that. And that's about it. So always remember that your most valuable asset is your time. Thank you for sharing yours with me, and I very much appreciate your time watching this video, and good luck to you. I wish you a better second half of the year. Of course, I'll be back with another video way before then, but hope you're having a very nice summer, and take care. I wish you the best. Have a good week. Thanks.